Hey, welcome back, everybody, to today's Market Explained, four-star podcast media event. I am your host, Brian Castle, and I'm here with our sometimes co-host, the return of Trader Jack. Jack Walsh is with us today. Chris Reardon could not be with us today. So, Trader Jack, welcome back to the podcast.
Thanks, Bry. It's always my pleasure to be here on this sunny Friday afternoon, and we've got a lot to talk about today.
We do, and we call Jack a trader, Jack, because he was a trader for years on the Chicago Mercantile Exchange, and then he went into working with private client investors and joined Four Star about 3 years ago. So we're happy to have you, Jack. And so Jack's a man of many talents, and he's also bald. So there we are. Uh,
There we go.
anyway, so welcome, Jack. And I'm Brian Castle. I'm the original host, CEO and CIO of Four Star Wealth. I'm also an advisor to CEOs and insiders on their transactions and working with high net worth wealth investors. I'm also husband to the amazing Tripty and dad to two wonderful young men, Evan and Quinn. So why don't we get started with everything here, Jack? The markets have been really interesting. Why don't we go through the changes since the last episode and the tug of war between different asset classes that we are
Sure.
tracking?
Sure, what we like to call is the Dolly scores. Uh, Domestic equities at 314, that was up one. In second, international equities, 255, also up one. In the third spot, commodities, 255, unchanged. In the fourth spot, it was cash, 118, also unchanged. Fifth, currencies, down one, and fixed income at 69 was also down one. So not too much change, but
Yes.
very interesting that international equities and commodities are battling for the number two spot.
So they're equal now, Jack, which is crazy. And so we do have a mixture in our dynamic account. We domestic equities are the lead position, so we got 50% there. But the second position is split between commodities and international for that very reason. But looking at the generals here, the domestic equities, commodities, and international, these are the risk on assets, right? These are things you do when the market is rewarding risk. And so the number 314, 255, and a tie at 255 for international. That's quite interesting. And then the three other asset classes have 118, 79, and 69, very low tally scores. So this would be a risk on market, wouldn't it, Jack? This would be a bull market, essentially.
Yes, and Bry, from our models, we saw that they started to change, and it's basically been a bull market for 9 months now. We saw a change in November of 2023, and it's been a nice run for the markets.
It really has, and we've talked in past episodes about these positions that are the technology, the Magnificent Seven, and that faded a little bit. There's like a Magnificent Four, but still a technology dominated market with a very, very narrow list of names. And that took a breather in the first quarter, but it came back in the second quarter. And so now we're seeing the technologies run again. So the S&P is beating the average stock in the S&P. Now, again, it did last year. But there's long periods of time where that's not the case, where the big technology and telecom stocks get hit, and then the other stocks do a lot better. And you could do better being in the average, the equal weight of the market rather than the average as it's calculated. So the difference between market cap weighted and equal weight. So over time, the equal weight is really how people invest. But the S&P 500 gets really distorted and out of balance for long periods of time. That happened last year. It happened in the second quarter this year. So we'll see if that continues to go on, and it'll go on until it's done. And I'd like to say, well, why don't you tell me a time how long it'll take? Well, we really don't know. So I always say it'll go on until it doesn't, and when it finally cracks, it'll crack. But we're seeing that now, and markets have been hitting new highs on the broader indexes and on the equal weighted indexes. And then recently, however, the Biden administration put out some discussions on restrictions on Taiwan semiconductors. So then all those techs got really hit the other day, Jack. And it looks like we had a rally then, and now another big, pretty big down day. But we're right near the highs. So even though you have a couple pullback days, that doesn't begin like a big decline, does it?
Well, no, it doesn't. It doesn't trade like it. I mean, you and I have seen panic sell-offs where there are no bids, right? And there is 6 trillion in money markets waiting to invest. And the argument for those big techs is that they have consistent earnings, and those big techs are not really influenced heavily by interest rates, right? So one of the issues for the smaller caps in the market in general is that those high rates that we've had for quite a while are really hurting the small caps. They have to go out and fund their businesses and things of that sort. So yeah, just recently we had a really nice pop in small caps, and that was off of the conversation that the Fed would be cutting rates. Some people believe it'll be in September and December. We've gotten some weaker numbers, so we will just have to see. But as of now, I would say that the market is in a seasonal sell-off. There's the old axiom: sell in May and go away, right? It is happening later this year, but people should keep in mind that this sell-off into the fall can just be fuel for that Santa Claus rally. And really, some of those tech names that are getting beaten up now, they might be great buys. So,
Well, that's right. And while we're seeing markets hit new highs, earnings have still been pretty good. And so we're really not seeing valuations out of control. The highest ever multiple in the S&P 500 was 23 times earnings, and that was back in 1999. And that included the tech sector really, really out of whack back then. Also, very high multiples, insane nosebleed multiples. And so that affected the overall benchmark price earnings ratio up to 23. So we're in the kind of the high teens right now, but we're by no means wildly overvalued. We're a little bit higher on the end of valuation, the average being about 17 times earnings, and we're a little bit above fair value. But we're not done. Now, the question is, do earnings start to pull back from here? We see lots of layoffs. We've seen employment issues. We're seeing slowdowns in a lot of different sectors. And what the Fed has been doing is they're trying to keep interest rates higher here to slow down the economy a little bit to ward off inflation. But they have to kill inflation because inflation is actually worse than having economic stagnation. So they're trying to get rid of inflation. And in the meantime, they're probably going to recess the economy. But now the market's still close to hitting new highs, except for a couple of pullback days this week. So what is that signaling? Could that be signaling that maybe the recession or the slowdown isn't going to be as bad as it could be? And then the market is already signaling a recovery for the fall. Could be because the market tends to be a discounting mechanism in advance. So maybe the market's saying, gee, we're kind of predicting that it's not going to be as bad on the economic slowdown as people think it will be, Jack. But it's possible that the economic slowdown gets worse, and then the markets could, tail off from there and go into correction. What do you think?
yeah, well, most of the stuff that I read, Bry, is still that earnings growth is going to be pretty good in 2025. I saw one estimate of earnings growth being 14%, up 14%, which takes you into your discussion about price earnings ratios. And that's where some people think the S&P could be at 6,100, 6,200, right? So the question ends up being, and you've got to, right on the button there, that how much of a slowdown, how much unemployment. There are some consumers that are stretched. Credit card delinquencies, repossessions of automobiles, all of those signals are saying that the consumer is stretched. But I think at the end of the day, when you look at it, big tech, big cap tech is still going to grow their earnings. And, bull markets are made on the back of earnings. So I wouldn't say that the bull market is over. I think there's an awful lot to worry about as far as geopolitics and U.S. politics. There's concern that the Fed is not going to be able to engineer this soft landing. But you and I know that the market climbs this wall of worry, right? So I would look at this, what I would call the sell-off into the fall. I'm not predicting that it's over, but I would suggest that that's going to be a buying opportunity off of the expectation of higher earnings in 2025.
Okay. Well, and that's what the market's telling us right now. We'll see if it plays out that way. Like we said, we could also at the same time see a resurgence of inflation because they're still running high deficits. And if they're spending so much money and they're running inflation back up, then we'll have inflation and stagnation all at the same time. And it could be a pretty rough market from there. So hopefully your scenario is more likely, Jack, than the one I described. But these are all things that can happen. And just by way of review, the last time we had very high moving interest rates, a big trend was back in the late 70s and the early 80s. Anyone who was around back then, remember interest rates got very, very high in the high teens. The Fed funds rate topped out at 16.9% in September of 1981. We mentioned these numbers and these statistics before. I remember having a 20% money market at a place called Lyons Savings and Loan out in Lyons, Illinois. And so rates were really, really high, but inflation was also very, very high. And it kept rates high to kill inflation, but it took almost 3 years to do it. Well into the term of President Ronald Reagan, after he got elected over the incumbent President Carter in 1980. And so Carter got blamed for all that, and much of it wasn't necessarily his fault, but some things were. But clearly, even though Ronald Reagan pursued positive policies to turn things around, it took a long time. It took 3 years to solve the inflation bugaboo. So if we were to let inflation get out of control here, it could be a serious problem, and it might be a hard to get it under control. Inflation is very, very persistent once it comes, and it's hard to get rid of it. We're still about 1.5% above where the Fed's target is on inflation, and it's eroding our purchasing power and a lot of individual investors' personal income. So it's a tough thing. Now we're in silly season, I like to say, and that's where all the politicians are running for office. We've got a presidential election on. So one of the candidates, the former president, is talking about adding the other day at the Republican convention, adding high tariffs to some foreign technology, and then bringing all that technology back to America. Intel has got a big plant they're building near Columbus, Ohio. So they're trying to bring, instead of having all our technology made in countries that don't like America, like China, for example, they're trying to bring a lot of that stuff home. And so if they do that, however, at the same time, that means, well, because we've tariffed them, we'll pay higher prices for some of that technology, but at least the jobs will be in America, but the prices could be a little bit higher. So some of that could even be a little bit inflationary. Now, there's another concern that we are seeing a large amount of immigration. Some people are calling it an invasion. 11 million people in the last couple of years have come into the country. But those people are also keeping wages down because they are flooding the markets for labor. So by flooding the markets for labor, you're seeing the price of labor or wages not go up much, which is not good for workers, but it is good for inflation, right? Because they're keeping prices down. So there's always trade-offs to all these economic trends. And, we're seeing now some concern that, folks are really hurting and they're not able to afford the same basket of goods that they were before.
Yeah, and Brian, I have a couple of comments on some of those topics that you touched on. First of all, the way the government measures inflation now have changed, and there's been people in the markets that have questioned that, right? Also, as far as interest rates go, the 70s, you didn't have I don't believe as much coordination among central banks with their interest rate policies, right? So the one thing that I always worry about, and we talk about, is that the value of the dollar relative to other currencies is relatively stable. That's a nightmare situation for the Fed and for investors. If we ever got capital flight, thank God that the U.S. equity market is the strongest in the world, because if we ever got a declining currency and capital flight, meaning foreign investors were starting to pull money out of the U.S., that would start to be like a waterfall. Lower currency brings in more capital flight. More capital flight brings in a weaker currency, right? And then we'd really get 70s type inflation. But for the last, I want to say 12 to 18 months, the currency has been relatively stable. So I think the market's voting that the Fed has done a pretty good job so far. Now, my other point that I would make is that governments, for a long, long time, when you have a debt problem, and we have a debt problem, they're likely to try and inflate their way out of it, right? Now, I think at the end of the day, they're not necessarily going to get inflation back to 2%. They're going to say that they're going to tolerate inflation slightly higher for a short term, because I believe that the Fed, at the end of the day, will help the Treasury with its debt problem, right? So, just a couple thoughts there, Brian.
Yes. Well, all right. Well, we'll see where it goes from here. We know that we're in a risk-on market. We know that the U.S. stocks and then commodities and international coming right behind them are working well. And some people, in markets like this get a little nervous because they think, well, it's too good, it's going to keep going, but it's going to eventually break. Well, we'll say that at any time the market can go into a 10% correction just because things got overheated, right? We haven't seen a correction, Jack, have we?
No, it's been, like I said, 9 months since we've seen a correction. And you could say, with all the things that are going on with politics and geopolitics, the VIX has been really subdued. I mean, it's been down in the 12 handles, it's up to about 15. But considering everything that's going on, that risk indicator, the VIX, has been very well behaved.
Hmm? Yes. Okay. Well, all right. Well, we'll see where it goes. Those are our thoughts on the markets. We did our final review of the first half of the year, and we found, the capital appreciation models did well. Some of the sector models did pretty well. The dividend income models did well also. So pretty much all stock models across the board did well. Although the big winner of the first half was the master limited partnerships. Those are the oil partnerships. And those are up substantially over their benchmark of all the master limited partnership and oil deals. So you could have done very well investing in oil in the first half. And of course, the financial markets were higher, and most of the portfolios we had were in line, or some were well ahead. So we had a good first half. So the big winner of the first half was the master limited partnerships of oil. Bitcoin stayed in the high 60,000s, like it's around 64,000 now. Gold is actually acting pretty well. Bitcoin was replacing gold for a while, then gold's replacing Bitcoin for a while. So those are assets that people buy when they're concerned about financial markets, or concerned about too much debt at the government. And as you said, Jack, we have too much debt right here in our government now. We've gone from 1990 of about 5 trillion in debt compiled over 200 years of our existence to 34 trillion in debt since 1990. And that's a massive amount of debt added. And it puts us in very risky terms as a country. And you say we can inflate our way out of the debt. That's possible. There's also talk on one of the candidates for president that they'll actually sell off assets and pay down some debt and get rid of some, then also reduce government spending. And so some of the problems of all this debt and spending, sometimes folks like to blame one side or the other. And we've seen, policy procedures and proposals from both sides that cause inflation and cause big debt. So it's really not limited to one organization or one party. Both have had a hand in it. Both politician groups spend too much money. There's seemingly no control. So we have to get back to a place where we have the fiscal soundness as a country to survive in the face of enemies and adversaries that would want to take us out. But right now, we're actually a little bit vulnerable. We have too much debt, Jack. What do you say?
Yeah. Well, the problem there, right, Bry, is that every administration kind of kicks the can forward, right? And my concern is that things really get fixed after a crisis. So it would be nice to come together and work out a plan and work off some of the debt. But I think people in the markets are concerned that things really get fixed and people come together after a crisis. And I always say, if you're watching markets, you got to watch the U.S. dollar. The U.S. dollar is the signal for a crisis. The old things that used to be watched, like gold, they don't act the way they used to in the 70s. Even though gold is strong now, it goes up in a very orderly fashion. So I continue to watch the U.S. dollar, and if the dollar were to fall and the bond market were to fall in reaction to that falling currency, then I would say that the Fed has a really big problem right now, because the behavior of the bond market, even though rates are not low, the bond market is not extremely volatile, and it's not reacting to the small moves in the dollar. So I think the Fed has a pretty good handle on it right now.
They seem to. Although I will say, they've been discussing originally at the beginning of the year that we were going to have many rate cuts this year. And then it went down to, well, we're not probably even going to have a rate cut this year. And now there was one positive minor move by about 1/10% in the most recent consumer price index number. And everyone's so excited about rate cuts because they think that that'll help move the markets and everything else, that all of a sudden the probabilities went to almost 90% that we were going to have a rate cut in September. So the markets react very quickly, and any little wisp of a positive in inflation going down, for example, all the betting, chattering class of people who bet on all these things, they're like betting that it's going to be a rate cut in September. Well, now we're starting to see that fade again. So we get excited, the probability goes upward, and now we're seeing that fade again, Jack. So we're down to about 70% probability of a rate cut in September. So what do you make of all that? The volatile emotions of this rate cut scenario?
Sure. Well, what was interesting about the first move is that the Fed had taken rates from 0 to 25 basis points up to 5.25, and you had positioning that was really offsides, right? So when they first started to talk about rate cuts and changing direction, it was in November of last year, and the rate market really skyrocketed, right? It priced in 6 to 7 rate cuts, and I think part of that was just the way the market was positioned. Hedge funds were short. Okay. So really that easing, and we saw with the financial stocks, Brian, that
Yeah.
the financial stocks took off, right? So that was like a preemptive easing without them even having to do anything. And then you were right. Over time, we took it all the way down. For a long time, we were talking about 1 or 2 or 3 rate cuts. We got it all the way back to probably no rate cuts. Just recently, we've seen unemployment uptick, and we've seen the cooling of inflation on a year-over-year basis. So I'll tell you, from my long time, 30 years on the trading floor at the Chicago Mercantile Exchange,
Mhm.
the story was then that the Fed moved after the markets moved, but this Fed, and I think because of the currency and because they want to stay away from that 70s inflation, have really talked the markets back from any type of easing expectations. And you've get times here, Powell continues to be the dove, soft, but then you have other Fed governors still hawkish. And you even had Jamie Dimon come out not too long ago and warn the Fed that they shouldn't ease too quickly. And Bri, that'll just take us back to in the markets, people believed months ago that when the Fed started their easing campaign, that the dollar would fall, right? And people would rush into commodities. Well, now, because there's so much coordination in the central banks, I believe that the European banks will start to ease first because the dollar being the reserve currency, there's an awful lot of coordination amongst the central banks. So I personally believe that the numbers are starting to weaken, and they would love to see money come back into the U.S. bond market so we could get lower mortgage rates, take some stress out of these financial institutions. Don't forget, it wasn't too long ago, as the Fed was raising rates, you had Silicon Valley Bank. You know, you've had a big rush of money coming out of banks and into money markets. We saw it here at Four Star. So I think they do want to get money market rates slightly lower. I don't think it'll be called a easing. I think they want to normalize rates. When short-term rates are at 5.25 and inflation is at 3%, you've got a positive real rate there. So I think in 2025, they would love to see rates come a little bit lower. Of course, we've got to get inflation under control. So those are my thoughts.
Okay, great. Well, we'll see. We do see gold keeps rising, and that's interesting. And I think a lot of folks are coming back to being gold bugs. Anyone who was around back in the 80s remembers when gold went to $800, an ounce. And there were a lot of investors when I first got in the industry back in the early 1980s. Yes, I've been around since the early 1980s, so 40-year career. And they would call themselves the gold bugs. And so they were buyers of gold. And since it went on for so long, 5 or 7 year trend, it's all they ever did was buy gold. They said, I don't believe in anything. I don't believe in inflation's killing us. We have to buy gold. And of course, then gold did nothing for the next 20 years and went down to $300 an ounce. So just when you thought that your market would never go down, of course it does. When we caution all investors that even though we've had a rally between November and now, without really any big correction, some people start saying things like, well, it'll never go down again. And, that right around the time you hear that is right when the correction begins, right? So,
yeah, well, I was just going to say that, some of the blame or some of the thinking is, let's not forget that the central banks have been buyers of gold for, I want to say, 3 to 5 years now. And the other thing that's pointed out is India, which is a very populous nation, has always, because of their currency turbulence, have always bought gold. And now people are saying because of the trouble in China, the Chinese savers are starting to buy more gold. So there's this idea that gold that was held in the West is moving east, and we've seen more and more investment banks start to raise their target for gold. And the good thing about gold, Bri, and this is going to be like very, very caveman like, is there is no counterparty risk, right? When you have derivatives, we all remember what happened to AIG and talking about counterparty risk. So gold in its purest form has no counterparty risk. So those people that are concerned about systemic risk, they have a percentage of their assets in gold. And I just think over time, currencies get debased. So there is an argument to have some gold, but you know, against the stock market over long periods of time, stocks have outpaced gold. So I'll leave
Yes.
it there.
Okay, good. Well, we'll see what happens. I mean, commodities they're the pure supply and demand, buy and sell. A lot of other assets have other features like they pay income, or you can live in it like a house, or there's different things you can buy that have different things that would create value. Even certain metals are used, for dental work and then manufacturing and that kind of thing. And gold does a little bit of that. Some people still use gold in dental work, but for the most part, commodities are really worth your commodity is worth what the next guy will pay for, and that's it.
Exactly.
No dividends, and same thing with real estate. What's it worth? You can say it's valuation. You can go on Zillow. You can do all those things, but your real estate is only worth what the next guy will pay for it. And when you get down to the negotiating table, you'll find that out. And sometimes you may not always be happy with it, and sometimes you'll be wildly surprised, as we've seen in certain markets here recently. We did talk about the real estate markets a little bit on our last episode too, Jack, that for the longest time, even though rates went up and the real estate market slowed down, transactions slowed down dramatically. Many of the real estate firms in the Midwest market, the East Coast market, all over the country are very, very much struggling. But yet we hadn't seen real estate prices go down because there was very, very little supply. And there's about 6 million dwelling units that still need to be built. There's a pent-up demand for dwelling units. That would be homes, townhomes, apartments, whatever it might be. And so the developers are working on that. And now some home transactions are happening where people are buying homes because the economy has been pretty good, but they still have a long way to go. But so because there's been a limited supply and they haven't been able to replace it quick enough, we've seen real estate prices hold up because supply was restricted. Well, now finally we're starting to see some crack in the real estate market. The markets that were hot before, Austin, Texas, Tampa, Florida, are not as hot. We're starting to see some cracks in those markets, and they were the hot markets. And then other areas which have been kind of long since forgotten about, the big cities in the north, like San Francisco, up in New Hampshire, New York. We're starting to see actually some movement, positive movement in those markets that had been kind of forgotten for a long time. And so everything has its move, everything has its day, but we are starting to see the real estate markets crack a little bit here. So we'll see if that continues. That's just a little bit of a blip. Again, a lot of it depends on how earnings come in, how personal income comes in, people's marginal propensity to consume their income. So it's a matter of how all these factors play in. Now, many of you have heard that economics is called the dismal science. Dismal science because there's so many factors that no one can really know all those factors at any one time. So anyone who's convinced that they know everything that's going to happen will probably lie about other things too, because there's so many things that can happen. You just don't know where it's going to go. But we try to present the different features that could lead to different directions, then we see just sometimes when we thought we knew the direction based on this move or that move, it goes the other way. So that's why they call economics the dismal science. There's so many factors, and it's hard to know what things are going to happen. But so right now, we just report on what's happening. Gold is rallying, and people are buying gold again. It feels like the gold bugs of the late 1970s, 1980s. So anyway, well, Jack, we're coming to the end of our discussion today, and in the what we see out there discussion, this is the summer of the political conventions, and for the first time in American history, they're all happening. All the two major ones are happening within 90 miles of each other, in Milwaukee and our headquarters city in Chicago. I have happened to be at the convention this week up in Milwaukee, and the former president remarked that the convention is bringing $250 million worth of new commerce to southern Wisconsin and Milwaukee. And of course, he reminded everyone to vote for them because they brought all this money in, which is what a politician will do. But the reality is 250 million injected into an economy like southern Wisconsin is an awful lot of money. I thought the president should have said what it caused as far as the GDP growth, right? And it would be a big number. I mean, on the scale of big numbers as GDP numbers go. So maybe 0.1%, maybe about 0.2%, but still that's significant to move the needle. So Wisconsin's getting a boost in business. And of course, in about 4 weeks in Chicago, we have the other party coming here, the Democratic Party, and they're going to spend just as much. And there are a little bit of riots going on, or all the things that happen at political conventions. But for the most part, it's going to be a big economic boost for both Milwaukee and for Chicago. And to have them both happen in the Midwest region, right on the shore of Lake Michigan, is quite a unique thing. So it's actually been a big boon for the area near our headquarters. So that's nice. And that'll be happening here, like I said, and again, about 4 weeks. Although ironically, Chicago is a major city with 2.7 million people, 6 million in the metropolitan area, plenty of hotel rooms. There were not many hotel rooms in Milwaukee. In fact, the Texas delegation had to go all the way to Madison, Wisconsin, an hour and 10 minutes away to get enough hotel rooms for their delegation. So Milwaukee wasn't as suited for these conventions. So it broadened out that economic impact all around the region, not just the city of Milwaukee. But in Chicago, for the other convention, the Democratic convention, it will all be economic boom primarily to just the city of Chicago, interestingly enough. But it's interesting stuff. And these conventions, like we said, happen every 4 years. And I think that's about all we had of things we wanted to talk about, Jack. How about you?
Yeah, nothing steps out there except that my hope is that in the future we get a candidate in the middle, right? It used to always be the left versus the right, and we'd get somebody that would move to the middle. So my hope is that we do come together as a country, and we come up with some good policies, so we don't have to go into a crisis before things get solved. And that's my hope, Rod.
Yeah, I agree. I would agree with that, Jack. Well, thank you. Just as we close here, I just want to highlight everything. So in the blog post on the leadership matrix, you can access the blog post and sign up for it if you like. It's the leadership matrix, and there's an article about the commercial real estate issues, the big updates periodically because of COVID and changes in the economy. We're seeing big vacancies and downtown office, commercial office. We've heard stories of buildings selling in 2019 for a certain number, and 3 years later selling for 70% less, a significant amount. We're seeing that in all major cities. And so there's a talk about the commercial real estate market. It's going to take a long while for it to recover. It's starting to recover in our home headquarters city of Chicago, but it's still slow. We're in a building that had been the tallest building in Chicago for about 30 years before the Prudential Tower was built in the 1940s. This building that we're in at 1 North LaSalle was built and finished just at the end of the just after the stock market crash in 1929. Beautiful building, but it's only about 60% leased. So we're seeing a lot of that. And so we have an article just updating everybody on what's happening in the commercial real estate market. Things are getting better, but it's still going to be a while. And a lot of buildings are going back to the bank, and new buyers will emerge and try to make a go of it. And eventually people will all come back to the cities, but it's going to be a little while. Let's see how it goes. Then also we've done some pieces on zombie companies and zombie countries. Now we want to talk a little bit about higher interest rates that essentially are causing zombie investors. So as interest rates go high, people carry a lot of debt, carry a lot of credit card debt. You maybe have a mortgage, and the mortgage is an adjustable. So the adjustable rate goes up. We've had calls from investors that all of a sudden they're adjustable. That used to be a 3% mortgage is now a 7% mortgage, because they kept adjusting the rate upward. And if you have interest rates rising and it keeps pushing more and more into your cost to make your payments, your interest payments of your mortgage, that causes you to be in a position where you could maybe default on your loan and mortgage. So a lot of folks are saying, gee, maybe I should pay off this mortgage or do something to limit my exposure. So this could lead to what we call, again, either zombie countries, zombie companies, or zombie people, investors, financially at least. So we have an article that talks all about that and the higher interest rates and how they affect the world and how we consume things. Then also, I just wanted to highlight, we did a podcast interview with a money manager named Chuck Brokoff. And Chuck is actually a 4-star advisor, but he's also a professional money manager. He's in our operation down in Scottsdale, Arizona. And a very interesting interview with Chuck. Chuck has presented at our conferences before. He's got a very interesting model on how to manage the risk of the markets. And so I thought that would be a good one to highlight. We're going to keep highlighting more and more investment ideas, different money managers, different alternative investments. And of course, we always talk about the stock and bond markets on our show, Today's Market Explained. So, Jack, I think that's it. Why don't we leave it there?
Brian, thanks. I really enjoyed it. Thanks for having me.
Thanks, everybody, for being with us again here on Today's Market Explained. We'll be back in a couple of weeks with an update on the financial markets and the world as we see it. Until then, bye-bye for now.